Yeah.
So yesterday we kind of introduced what the resource or the labor market is, talked a little bit about marginal resource cost, which is the wage, and then marginal revenue product, which is how much revenue each new worker generates. And so 5.2 gets into what shifts the supply and demand for labor in the market, and then 5.3 we go into essentially perfect competition, but it's perfect competition for the labor market. And then 5.4 we'll do monopsony, which is a monopoly in the labor market. But instead of having 4 different markets like we had in the product market, there's only 2 markets in the labor market. So at least that part's nice. But shifters for the demand and labor. Remember, the businesses are the ones that demand the labor now. So you, the individual, supply your labor to the market. The businesses demand the labor, and then eventually, hopefully, you get hired. But things that shift the demand. So the price of the output, or what we call derived demand, is related to what happens in the product market. Let's say the demand for a product goes up, and producers are going to produce more of that product. Well, if they're going to produce more of that product, they're probably going to need more workers. And so you're also going to see an increase in the demand for labor to produce that product as well. And so that's what we call derived demand, is that because of the increase in demand for the product over here, the product market, or I guess if we've got that circular flow diagram, the product down here, it also increases the demand for labor up here because we need more people to produce more stuff. Does that make sense? Okay, that's derived demand. Productivity of the worker, obviously, if you are a good employee, you produce more. If you are a bad employee, you produce less. It's that simple. And then change in the price of other resources or substitute and complementary goods. So substitute goods, in this case, we have human workers and we have, we'll call it quote-unquote robots, but that could be like self-checkout and things like that. That when those technologies get cheaper, businesses have to decide, am I going to continue to hire humans, or am I going to spend money to do more self-checkout and things of that nature? It really depends on the price of the resources. So if self-checkout gets cheaper, well, businesses are going to consider that. It gets into the argument that it doesn't really, usually it doesn't mean that humans actually get fired. A lot of people will get up in arms that they won't even use self-checkout because they're like, it took someone's job. It didn't really. That worker probably just got retrained. That instead of checking someone out, now they're restocking shelves or cleaning or assisting customers or doing something else. It actually is good for the business. But from a cost standpoint, it's cheaper to employ people, to do other jobs instead of now checking people out because we have technology to do that. But anyways, when that technology gets cheaper, then you're going to see a decrease in demand for the more expensive labor, just like we saw in the product market. Now, when the substitute good gets cheaper or the original good gets more expensive, then businesses are probably going to go with the cheaper option. If the minimum wage goes up and businesses now have to pay workers more, but they can do automated technology cheaper, they're going to consider that because the goal, remember, is to maximize profit for all business. But anyways, complementary resources says what happens to the demand for loggers, the price of lumber increases significantly. And so this is kind of like derived demand in a way, but if the price of lumber increases, which means the business is going to now want to produce more. So over here in the product market, we see an increase in price, and so there's going to be an increase in the quantity supplied based on the law of supply, not demand. And so the business is going to want to produce more. Well, if they want to produce more, they're probably going to have to hire more workers. And so you're going to see an increase in demand for labor because the price of the product went up over here in the product market.
And what caused that price to increase, like demand or?
I don't know. Whatever. Lumber got more expensive. COVID, forest fires. Take a pick.
Oh, so they can just go, hey, this is now $20 instead of $15.
Yeah, I mean, it's, let's say there's a bunch of forest fires and we lose timber. Well, then that's going to raise the price of timber in the market. And so, they're probably going to want more people to mine as much timber, not mine, but cut as much timber as they can. For whatever reason, thousands of hypotheticals, whatever the price goes up for the product. We don't know why. We just know how it's going to affect these markets over here. This just gives you a bunch of examples. I'm not going to go through every single one, but take number 1. It says the increase in demand for microprocessors leads to an increase in the demand for processors. Same thing. Now we've got an increase in demand in the product market, and so they're going to want to produce more. If they want to produce more, they're going to hire more workers. And so we see both markets affecting each other. All right, shifts for, what's up?
Never mind.
So shifts for supply of labor. Remember, you are the supplier. You are the individual supplying your labor to these labor resource markets. And so education and training, people get smarter, and they're going to be able to enter new markets. Availability of alternative options, as technology changes, new markets open up, and so people are able to enter these new fields that used to not exist. Immigration and mobility of workers, and so depending on different markets, especially in agricultural markets, you see transition of workers throughout different times of the year, and so that affects the supply of labor in those markets based on where the workers are. Cultural expectations, just depends on, what country, what culture you're in, has different expectations of how much and when people should work. Working conditions, which obviously in a first world country, these should be pretty good, but if you still live in a third world country, sometimes working conditions are questionable. And then preferences for leisure, it's just how much do people want to work. And that one's kind of related to income too, that you kind of see this actual kind of skewed labor curve looking at people's income, and it's like, and this sounds bad, but when you're poor, you want to work a lot more, and then when you get moderately rich, you don't want to work that much, but then you look at actually statistics for your extremely wealthy people, and they work a lot. And so it's like this middle gap of wealth that people don't want to work, I guess, when they reach a certain status. That it's like your most successful people still work like crazy. But anyways. All right, so last thing we'll do for 5.2. So the market is for lawyers. So an increase in the demand for lawyers. This one's about as straightforward as you can get. What's going to change? Supply or demand? Demand. Is it going to increase or decrease? Increase. Like I said, it's as straightforward as it can get. It's an increase in demand for lawyers. Number 2, a decrease in the number of law schools. Is this going to affect the supply or the demand of lawyers? Supply. Good. Is it going to increase or decrease?
Decrease.
Decrease. Good. And a lot of this is common sense. If we see a decrease in law schools, we're going to produce less lawyers. And so therefore, there's going to be a decrease in supply in the market. A decrease in the price of software that performs the same task as lawyers. Supply or demand?
Oh, demand.
Demand.
It's not going to have enough. It's not going to be a demand for lawyers.
Yeah, because now you've got substitute goods. Well, substitute options. I don't want to call it.
How would that even work? Can you imagine like sitting a computer out there that's just like typing out your
It's getting closer. Now you see this more prevalent in like the accounting field. That if you look at all the software that's out there that can do your taxes for you, it has greatly replaced the demand for CPAs that do taxes.
I wish I knew how to do my taxes.
Y'all's taxes are pretty straightforward. Now, when you get older and you get more complicated tax situations, it's not always a bad idea to still hire a CPA to help you. That way you don't get audited and go to jail if you do something wrong. But
why can't they just tell you how much you owe? Like, because they know how much you owe, don't they?
Because we have an extremely complicated tax code. It's hundreds of pages long.
Ooh.
So there's a lot of proposals out there to, there's ways, like if we went to a flat tax where everyone just pays a flat percentage, we could essentially make our tax code 1 page long. That it's no exceptions, no tax breaks, no whatever. You just pay 10%, whatever it is, would simplify things. But we don't want to do that because people like tax breaks. But anyways, moving on. But yes, software gets cheaper. It does the same thing. It's now the cheaper alternative. So you see a decrease in demand for lawyers, an increase in demand for the cheaper software. 4, an increase in the number of students that attend law school. Supply or demand? Supply, increase, decrease? Increase. Number 5 is pretty good though. A minimum wage of $15 an hour. Or it should really say a minimum wage increase to $15 an hour. So it's going to affect the supply or demand of lawyers.
Or demand. But I feel like it's...
So
Companies aren't going to want to hire as many people.
So think about what we talked about yesterday.
You said, like, if you bring it up, they're going to have to fire people. Not fire, but, like, you have to go through.
You're on the right track. We're getting closer. Alright, so what is minimum wage specifically?
How much you have to pay somebody, like, to work. The
Close.
floor.
Well, I guess let me rephrase that. I'll just tell you. So, minimum wage is a wage floor. We talked about that yesterday. So, a wage floor above equilibrium has an effect on the market. How much do lawyers typically make per hour? More than $15 an hour?
Yes.
More than minimum wage?
Definitely.
So, would your wage floor be below the equilibrium wage in the market?
The minimum wage is $15.
If we're proposing, it doesn't.
I'm about
Hang
to
on.
say I'm getting
Hang
paid
on.
way
You're
less than minimum
overcomplicating
wage.
it. So, we have a minimum wage, which is a wage floor below the equilibrium for the market for lawyers. Is it going to have an effect on the market?
Not really.
No. So,
Pay more everybody. Okay, that's.
so it would have no effect on the supply or demand for lawyers. Because it's not going to matter. Their equilibrium wage is above $15. I mean, let's say lawyers make $90 an hour or something like that. Well, a minimum wage increase to $15 an hour is going to have no effect on the supply and demand because it's going to be a wage floor below equilibrium. It's kind of like a price floor below equilibrium. It has no
But if
effect.
this was like, a fast food restaurant, it'd have a change.
Very detrimental effect.
But because it's lawyers, it doesn't have a change.
Correct.
So, for example, fast food, and what you said yesterday with the people would be
So
fired.
you would see that surplus of workers because then, if I'm making $8, $7.25 or whatever over here, but I can go over here and make $15, we'll do that. And so then you're going to see that influx of workers, but businesses aren't going to be able to hire as many, and so then you're going to see an increase in unemployment and that surplus of workers. In California, kind of went through this and didn't really. Economists tried to tell them like, hey, you're going to run into some issues when they just threw out that $15 minimum wage, because then businesses weren't willing to hire as many workers. And so you actually saw an increase in the wages, but then a lot more people claimed for unemployment because there weren't as many available positions out there. And so then it kind of created this domino effect of, all right, now we've got to give these people government support because they're filing for unemployment because there's not enough available positions. So, I mean, it's kind of a back and forth. I mean, there is no 100% correct, we need to do this to help society. I mean, there's pros and cons of everything. But we just look at, remember, this is all theoretical. We're not getting into the opinions or what we think is right or wrong or all that. We're just talking about statistically, this is how it's all going to turn out. But anyways, that is 5.2.